Hey folks, this is John Miller, Executive Editor with WB News. We would like to welcome you to Ask the Experts, featuring John Halderman of Beacon Wealth Management. John is the founder, owner, and certified wealth strategist at Beacon Wealth Management. You can find out more at bwmwb.com. And now live from the studios of the Exponent Telegram in Clarksburg, West Virginia, let's Ask the Expert. Welcome to Ask the Expert. Today we are joined once again by John Halderman of Beacon Wealth Management. John, welcome.
Thank you, John. How are you doing?
I'm doing well. I'm doing extremely well. Let's talk about, we always like to talk retirement because that is your area of expertise. And there's been some changes in the past, and I'm sure there's some changes coming up. We're getting towards that end of the year. People are looking at their pay stub. They're looking at their taxes in the future. What are some of these changes we need to be concerned about, and what can we do to help ourselves out?
Okay. Well, the biggest change that just happened recently at the beginning of this year was a thing called Secure Act 2. And part of it was absolutely wonderful. I will say that. But part of it, which is a big, big deal, is a big tax hike. And people don't even realize it because, I always say, I joke around and say, how many of you spent the Christmas holidays, nothing to do, and said, hey, baby, why don't we read the Secure Act 2 laws? And I said, most of you probably didn't do that. Now, myself, I do that kind of stuff. My wife, she's an accountant. So for us, that's not a big deal. But for the average person, and if you didn't know it, okay, Secure Act 2, the biggest takeaway I thought was what I called the beneficiary IRA. And what I mean about the beneficiary IRA, everybody, no matter who they are, will probably leave money to somebody potentially through their retirement plan. Everybody has a retirement plan, and you have a beneficiary. Well, in the past, when that beneficiary received that money, they could keep it in an IRA for the rest of their life. They never had to take it out. All they had to do was pay what they call required minimum distributions. And so for the average person, that was only usually somewhere between 2 to 5% a year. So if you were an inheritee, you now had this ability to continue to grow money on a tax-deferred basis. Well, guess what? Secure Act 2 ended that. Now you only have 10 years to take a distribution. 10 years, that's it. And why'd they do it? Because the government needs money. And so that it's so much easier to get money on the backside than to raise taxes on the front side. And so now when you inherit this as an inheritee, you have to take this money, and whether it's in year one, spread it out, or over a 10-year, one way or the other, you have to fully take it out. And the biggest problem is you owe taxes. And not only do you owe taxes on that money, it could increase your normal tax bracket. Because if you're making good money already, let's say you're making $100,000, $200,000, and you got a $500,000 inheritance, and you just cashed it out. Well, that means you increased your taxable income by $500,000 that year, which now puts you in the highest tax bracket versus being in more of a middle-of-the-road tax bracket. So it could end up costing you a lot of money just by not knowing what's going on.
So is there a way, John, so if I would get an inheritance, I have to take it out in that 10-year?
No doubt about it. You have to take it out. Where the planning is needed are the parents. I got to tell you, parents and grandparents, it has changed the planning that they need to do. Because, before we always wanted to leave money for our children, our grandchildren, thinking that it's going to better them. But in reality now, it might end up causing them tax burdens. And so what they have to do is they have to say, okay, how should I leave this money? Should I leave it in qualified money that's never had taxes, or should I do something different? And I got to tell you, there's a lot of ways that you can change it. You got to do planning, though. You could do Roth conversions. You could take distributions out yourself and use that to purchase life insurance that's going to go 100% tax-free to them. You can do QCDs, which are qualified charitable distributions. But there's a lot of ways that you can make it better for your children. But if you don't know that it even exists, and then you don't do the planning or the strategy, then your children definitely could be in a bad position.
This is kind of a ballpark question, but I mean, at what age should somebody, like people our age are probably having children, some grandchildren, they're thinking about, okay, I want to leave money for them. I want them to be better off than I was, that type of thing. So at what age do we need to start thinking about those tax?
Well, I tell you right now, because here's what I always tell every retiree, okay? Is your money for you in your lifestyle, or is it for your children? And, for a lot of times when people first retire, they're 60 and 70, okay? Well, they're going to use money for themselves for a while. But eventually they get to a point where they're thinking, okay, I've lived it, I've enjoyed it, my health is changing. I want to now focus on inheritance. Well, the minute you fully turn to that mindset, you got to be thinking, okay, what's going to happen with this money? Because, I just had a client just recently. They passed away. $5 million, is going to their children. And their children are stunned by the fact that they have to claim this money sometimes in the next 10 years. They had no idea that, number one, their parents had it. But then number two, they didn't know the rules. And so to them, this is a blow away for them, a total blow away. And so, so planning could prevent all of this. I mean, it really can. So I tell people, if inheritance is on your mind or wealth transfer is on your mind, you definitely got to start the process now.
Yeah, that would be quite a shock to inherit $5 million and realize you have to take out $500,000. You're basically increasing your tax responsibility.
Absolutely.
$500,000 a year.
Absolutely. And, and if you know anything about tax brackets and how they work, they're progressive. The more you make, the higher the tax brackets go. And so it adds to your total income. So clearly it can add a burden not only to the money that you're inheriting, but the money that you earn. And so, some people will say, yeah, but they can just take it out of that. Well, but that's less money that they're getting. And that was never the intentions of anybody who's focused on wealth transfer. Everybody who's focused on that wants to leave their children the most they can in the most tax advantageous way. Just unfortunately, if you don't know the rules, unfortunately, it happens. And like in this case, these people were very smart people. It wasn't like they were just, they didn't have knowledge. They weren't educated. They weren't responsible. They just didn't know the new rules. But my clients who inherited this money, they do know the rules because I told them, and they're shocked by it.
So what you do a lot of presentations. You talk to a lot of people. What do you think the percentage of people that really know those rules is?
Oh, less than 5%. Because just like I said, who sits around and opens up the tax code and says, you know what, honey, we got nothing to do tonight. Let's study the tax code. No one, you get highlights. And the way we are today with highlights, we cut off things too quickly. Now, like I said, there are some good things that came out of Secure Act 2. One of my favorite things that came out of Secure Act 2 was the 529 plan. 529 plan works like this. It's designed for college education. And a lot of people were saying, hey, I didn't want to put in there in case my children or grandchildren didn't go to school. Well, now, if they don't go to school, it's always been you can transfer it to other beneficiaries. But now one of my favorite things is you can actually convert it to a Roth IRA for them. So now if they don't use it for school, they can use it for their own retirement. And if they keep it to 59.5 and have it for 5 years, then it's 100% tax-free. So that's a big, big deal. So that's one of the positives. And there were a lot of Roth additions to the code that did make it more positive. They did soften the rules a lot for emergencies and 401ks. I'm not a fan of that part because I'm a believer we're already in a situation where we're moving towards a big retirement epidemic. I believe that young people aren't saving enough, and to give them flexibility to take more money out will only hurt them in the end. But I know that also people don't always think about emergency funds and different things like that. So the 401k is a place where they tend to go to and abuse taking money out unnecessarily.
Remember, unless you're sitting around the Christmas holiday reading up on the tax code and the retirement part of it, you need to talk to somebody who's got the information. John Halderman, Beacon Wealth Management, always a wealth of information here on Ask the Expert. Anything to wrap up with, John?
No, I think you said it perfect. It's about setting down. If you have questions about your financial future and you can't 100% look in the mirror and answer those questions easy, then you've got to seek somebody that can help you. And don't be afraid. Too many times people, I've heard people say, I've been meaning to call you for 5 years, but I was intimidated. I'm like, what about? They said, I don't know, and I tell people, no, call somebody and ask for help, because most people like myself, we're professionals. This is what we do. We want to help people.
Again, thanks for joining us, John. Until the next time on Ask the Expert.